Hello, ladies and gentlemen, and welcome back. In 2022 and 23, many people talked about trend lines along with other confluence techniques to find the highs in markets. But in 2023, should we realistically be looking at the NASDAQ versus the S&P 500 and deciding what's going on when it breaks out? Well, this is a very important thing because for years, the NASDAQ outperformed the SPY. And this means that at a critical point like we are right now into CPI, we know something big is about to occur. But it also brings up the next question. What do retail traders like to trade? The answer is quite simple. We love technology. We love AI. So is what's happening in those particular sectors right now of concern? Well, we take a look at a deep dive into the options and the opens of markets because it turns out that we're doing something that we did back in August of last year, and the results were not pretty. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. We've got a whole bunch of charts coming up in today's session, along with the key macro, news, and lead indicators. So yes, of course, retail traders are back. Investors are running everywhere, but they only have eyes for a few stocks, specifically Tesla, which we saw break out of a key zone and then actually reject in the middle of it. And then, of course, AI, NVIDIA, and others moving right through this ChatGPT craze. So do we need to be careful in these markets right now? Well, I think the spread of the idea or the party has probably gotten close to crescendo. And what we saw over the last 24 hours in terms of movements could be pointing to potential blow-off tops. So we need to be careful about that. There are certain things that tend to happen in those, and we'll talk about those in today's video. Let's move over to our Twitter now, where we've been sharing some excellent charts. And I wanted to bring your attention to this one to start off with. And that is the recent survey from the AAII. And basically what this shows you is that bulls are back in terms of everybody believes that there's a new bull market and the bears have gone. Now, this is the highest reading that we've seen in over a year for bulls. Wow. I'm actually surprised. I posted this and I went, wow, that is huge. And then it turns out the market fell about 1.8%. But yeah, this was a massive switch. 25% responded as bearish over the next 6 months. 37.5% said they had no idea what's going on. Fair enough. And then 37.5% said we're in a new bull market. Now, it tends to be when we get these type of sentiment switches that we need to think contrarian because that becomes a very, very important component. We've talked about February being a partially weak month for things like the S&P 500 and the NASDAQ. Here is where it tends to go bad. Around the 14th or 15th of the month tends to be where we see rejection. Now, what do we know is coming up next week? CPI. So there's a lot of things at stake here. We've got seasonality weakness for the S&P 500 and NASDAQ. We obviously have huge news. And we also have an out of control interest rate. All of a sudden, interest rates are going back further and further and further and closer to where they were before this whole rally began. So should we be concerned? Well, it's a data-driven Fed. So we know that if the CPI result ends up showing some kind of increase, let's just say that happens, the consensus is obviously that it's going to go down. But if it doesn't, will that cause incredible dumps in the market? I think it will make a large move and it could begin a new trend. So I think the next week is going to be one of the most important weeks of 2023 leading forward. S&P forward EPS, we've talked about this before. We turned negative the other day. That often precursors bad things in the market. It's just something that we do look at. And of course, we also look at the bonds market here, and we can also see that basically crap junk grade bonds have tended to be holding up better than you would expect. The split between them and 90-day US Treasury yield percentages, well, we know the times that this has happened in the past. And let's just say the market wasn't so happy after those periods. Certainly, it means that people are not adjusting for risk as much as they should be. We also talk a lot about the Fed pivot. So people are carried away with this being the market and it's going up forever and it won't ever come back. I'm here just to say one thing, that even if this is a new bull market, we traditionally do see pullbacks. And you've got to remember as well that at some point the Fed will pivot. They'll hit what we call a terminal rate, and then they'll have to start cutting it. Now, remember, they're not going to be cutting because the market is healthy. In fact, traditionally, when they cut and we have massive inverted yield, as we've shared here before, it tends to actually be a declining market condition. Now, if we weren't inverted and we saw cuts, oh, it's glorious. I mean, of course, that means that the markets are going up, stimulus, it's all great, let's go, and it's a great time to buy. So we have to put things back into perspective. It's very tough to do this, especially when things are moving heavily and you may have missed out. Remember, traders don't care, they look for opportunity. Trade investors certainly care, and investors, you need to have a plan because you're looking at the longer time periods. So when you're talking about longer time periods, wouldn't it be better to consider some things like medians or means? So the 25-year average of the S&P 500 forward PE, we know the market trades 12 to 18 months in front, is a great area to be considering what you're going to be doing. Now, we're just slightly above this, but if the market starts to fall, of course, we could move down onto this. I've got an updated chart coming in very soon, and we do share these weekly over during the earnings season on Twitter, so make sure to follow us there. But this is the type of thing that you could stack with other reasons such as the VIX and other things to maybe feel less FOMO in markets. And I can say that it's a fairly decent opportunity for somebody that's just looking and starting to get into the markets. If you haven't already, consider following us on some of the other socials as we go through the charts. We're about to get into those. But do remember, we have 3 free trading cheat sheets. We're also loading up a TikTok soon. And of course, we've got a Twitter, Discord, and a whole bunch of private community trials and stuff if you're interested in getting hold of those. So let's get into the charts. And this is where things get pretty exciting over the last 24 hours. It was a fairly large move. And basically, the VIX did spike up, which you'd expect it to. It got back above 20, which is very interesting. And we now know that, of course, there are some sellers in the markets. I mean, otherwise the market wouldn't have sold off over the last 24 hours. We also know that yields continue to spike higher. So this is where we're at in terms of the terminal yield. Somewhere around August of this year to September is expected to be the highest yield in the US. And this is where most central banks should hit what we call terminal rate, the highest point. 5.135% is the average. What if this goes past this alert? I would think that you should have an alert above 5.25 and chuck it in your charts, because if that happens, it's not good for the market. The market will not like tech stocks off that kind of news. It's very sensitive to these interest rates. Here at 4.5%, we've also got another critical zone. And most likely we're going to hang around these kind of areas into CPI. I wouldn't be surprised at all if the market kind of goes floating up and gets near critical zones ahead of big news. That tends to be what happens. Markets will move towards key supports or key resistances or supplies and demands ahead of massive news. So yields is well worth watching. What about bonds? Well, bonds don't like increasing yields, but they also don't like increasing risks. And high yield bonds, that is junk, declined. Now, it broke through both of our little ranges here, setting off all our alerts. Is this a cause for concern? Well, it's certainly one thing to say, okay, things are starting to look a little bit more defensive in markets. And we've seen this play out before where high yields have led the market down or gone with the market, and it's not been good. So high yield bonds, they're back on the table for us to be checking out over the next couple of sessions. You'll also want to be looking at TLT, which will have declined, as you can see here, but not as much. And we've got some key zones down around these 102s. So if we can get down to here, remember, treasuries theoretically are an interesting investment in 2023, but only when we know that the Federal Reserve has hit the terminal rate, because at that point we get cuts. Those cuts are to support the economy. And when you get cuts, you tend to see increases in treasury yield. So that's something that's important. Let's move over here to the dollar index. Now, this is where the strength has come into it over the last couple of weeks. The fear in the markets, or at least the fear and maybe some of the big money, has pushed literally the US dollar much higher. Now, it did have some interesting reactions. You can see at the close of the day, this close, or this level here, the 102.87, which we were looking at very closely, ended up rejecting back above and created another wick. And it kind of looks like it wants to move to the next level, which would be somewhere around 105.25. So are we going to actually see further bullish momentum from the US dollar? Well, we've had some weakness on the small charts. We talked about the idea that literally this area in here and this area in here were short. First profit target levels were in here. And this is where things got a little bit sneaky. So let's go down to the smaller timeframes and better understand it together. 15-minute chart here, you can see that it goes underneath. It makes a lower low, and then it just switches that completely, and now it's on a run. If this does pull back over the next 24 hours, you have to believe that there are buyers probably willing to commit somewhere between that 102.87 and 102.75. this was clearly at this stage a false breakdown. And the evidence kind of is stating towards that fact. Where are we right now at the time of recording? A potential supply that could push this market back down. But down in these areas, it looks like there could be buyers. So it's going to be an interesting scalpers kind of day for, let's say, dollar index players. And the main reason is because we're at those kind of critical zones through these markets. Let's move over to gold. Fell off, made the new low. What happens here is going to be key. Most people are going to see this as a flag. You're not wrong. I mean, of course, you would be thinking this is absolutely short right now if you considered that. So generally with flags, especially when they're so obvious, they'll often come back and they'll test the trend line from the down below. We already know that's what's happened. This will probably be the pivotal area of the next 24 hours. And I would expect this to be where gold makes its decision, whether it's going down, and of course the US dollar should be going up at the same time, or whether it just false broke to a new low. And if you rally in past these midpoints, you're starting to say, okay, gold's probably moving back to those 1920s. Now, gold hates yield increase. So if yields continue to increase, the US 2-year, 10-year, and all of those, gold will not like it. And that traditionally will send it lower. What about copper? Well, we haven't really changed our opinion here. If anyone's been watching the show for a little while, in the last couple of weeks, I've basically been pretty negative on copper. I believe copper was showing weakness, which was showing us that potentially the market was starting to weaken at these critical areas. And so far, so good for copper. Some little rejections here. I'm hoping that it continues down. Trend line coming up very soon, but the way that it's mounting a kind of attack into the trend line presents a decent opportunity that may go to 3.8. And that's something we're looking for. We're looking for weakness across those metals after Chinese New Year. US oil. That's a really tough chart. It really is tough. And you know what? I'm just going to leave it for now. If I was to pick any direction, you'd go with here's where the shorts look like they'll come back in just because we've seen it breach past that low. But I do think it's a bit of a tougher chart on oil at the moment. And that's because this $70 area is too manipulated by governments around the world. And that's causing a bit of concern. What about natural gas? We saw some spike off that zone that we talked about in the previous session. However, natural gas is certainly not out of the problems yet. We do get some nice little rejection wicks down here. We've got obviously our daily long leg doji, but I think natural gas is more of an investor level for people that believe in it long term. It's fallen to a critical zone, but we haven't seen enough base yet. We'll continue to follow it. Now, this is where things get a little bit, speculative for sure. And this is clearly in some kind of squeeze. Did it just blow off in the previous session? We saw an incredible rise of Tesla. I think it was up like 6+% at one point during the day. It broke through my critical extreme zone 1. That stupid daily close previously probably pushed this thing through. It just didn't come back the way you'd think it to, like an Nvidia did, which we'll look at soon. And then we saw it just rally. This has so many calls floating all over it, and it's retail calls. So this is creating squeezes. Now, I don't have it here, but I'll put a short interest on it so you can see the big short interest increases. Clearly, a lot of people have been liquidated trying to short this thing off. And look, rightfully so, they're trying to attack it, but it reminds me a lot of AMD's runs or even GameStop's runs and AMC's runs. Oftentimes, if it hits your critical, you have the correct risk management around there. And say you've taken an option short here and you had a few days for it. Well, it's not over yet, is it? It's come back down. But if you do it with a CFD or a stock pure short, you're going to have a lot of problems. Instrument selection is very important. Do I think it's gone past my targets? Well, yeah, I mean, extreme zone 1 and these areas here were my second targets. And this is my third one. So if the market does recover, I could still see Tesla potentially push into the 220, 230 range. At this point, it's in the middle of nowhere with a rejection on it, but we'll have to find whether this is really going to be that huge blow off that comes down. Look for things like gaps into the next open short if you're a day trader, and you'll just have to be very, very careful about this one. Tesla is at extreme points. You can see the real stacking going on here between the bulls and the bears. We've got huge amounts of calls coming through all over these 200, 205, 210, 215 strikes. This is similar to other times when we've seen huge squeezes, and there's a lot of puts as well. So clearly people are trying to short around this level. It's a very tight zone, $10 each way, and is creating a huge amount of buzz in these markets. But Tesla is the most traded for retail right now. I think it was like almost 14 or 15% of the entire market options last week. So it really has one of the biggest potential squeezes on it, and that's why it's so tough. We hit extreme zone number 1. I wouldn't change anything about it, but that daily close warned us that if you were short, you had to clip near the daily close. Check daily closes, guys. It's a good kind of recommendation out there, just to, whenever you're doing technical analysis, check those points out. And of course, I'll put my hand up and say, yes, I thought the extreme high was potentially going to short. And then, of course, by the daily close, I was less clear on that. But that's what trading is. You make a decision, you use replication. Sometimes it will work out, sometimes it won't. We'll look at one that worked a little bit better a little bit later on. So let's check out Apple. As you know, this is in a critical zone. At this stage, basically, it's in the middle of nowhere. It's creating potentially a sell-off. We can see volume has spiked around the earnings. Now, it tends to be that Wall Street loves selling into earnings. Like basically they buy the rumor, they sell the fact into retail. And if they want to sell a ton of units, they leave it there for longer. Remember, the longer it sits there with high volumes or decent volumes and then falls through, the more likely Wall Street sold tons of positions to retail traders, leaving us holding the bags. I thought I'd bring up Meta because it's very interesting as well. We saw huge gap opens due to the earnings after the close. And then we've hovered through this area for the last couple of sessions. Of course, big volume again. Potentially, we could gap down. What does that look like to a lot of people? Well, it could be an island reversal. Now, I'm not sure if it's super premium island reversal, but there's a lot of gap in that area. And if the market does start to free fall, Meta would be expected to fall a decent amount with it. So here's our NVIDIA. Here's our watch reaction area. You can see the last 24 hours. We've now got 2 red candles coming off this. It was touch and go there. Of course, it did rally through the start of the session, then sold off near the end. Certainly wasn't the weakest stock of the day. One of the weakest big tech stocks was definitely Google. That whole BARD thing is really not working out for them. We'll check it out in chart in a second. But yes, rejections off here. Let's understand the smaller timeframes. We got that gap open, people looking for the gap close, collected it on the day, so very nice. And I'd probably like to see what this does over the Friday session. It'll be based a lot on the rest of the market, but at this stage, it's one of the AI stocks that's been stopped in its tracks. Very difficult to do this. Remember, picking tops is super difficult, and usually you have to have instrument selection such as options to protect yourself from these positions. Let's move over to Google. Yeah, it was a pretty bad session. Went straight through the trend line, broke to the low, filled the gap, literally filled the gap, and now it's rejected back up. Huge 2 days of volume. If the market does stabilize, I could see Google kind of finding some little buyers here, but that doesn't mean the selling is over. You know, Google, as I mentioned in the previous video, if you actually have a look at their track history, which maybe we could do on this channel, it's not good when it comes to making their own stuff. And they didn't start YouTube, they bought it. And they're good at reiterating concepts, but in general, their track history, as far as I understand it, has a lot of broken programs over the years. So yeah, I'm not sure if I'm feeling too confident about the BARD at this point, but overall, of course, still a very good quality stock at the right prices. Let's have a look at some international markets now. We'll check out the UK 100 to start with. Yes, the FTSE showed 2 rejection weeks now. So again, some weakness there. We're not through to bear markets. Obviously, we need to watch the reaction at these 7706s to see real turnaround, but an interesting point. Here's for the Australians. I've just kind of put up some key levels. And you'll notice again, the risk reward up here is not very good. And that's a big point of what I said to our private community as well. If you ever check it out, 7-day free trial, link tree down below. But realistically, I said in the last couple of sessions, you know, risk reward is very important. If you miss a rally, how much more is there left in it? So something like this, if you're looking at the XJO, the ASX 200, or even the FTSE, do you want to buy here? Realistically, is that a place that you wish to buy under any circumstances? Generally speaking, unless you're a scalper or day trader, not really, because you're not going to be nimble and fast enough. And there's a good chance that it could come back down to like a 61.8 fib, 7,200, and then rally through. So this is certainly not the area you'd be buying. And you could definitely notice people trimming here. And a lot of the markets are hitting these zones, whether it's CQQQ, which is the Chinese index that obviously we've been looking at as potential weakness coming forward. Big volumes, potential sell-off zone, obviously a critical level. Whether it's the US 30, here's the US 30. Where are we? Well, we're right at the potential of a breakout either way, stuck in this damn triangle. So again, it's not really a huge, great risk-reward program here for a trade investor or an investor at these levels. It's just not worth it because you can see the extreme zones coming up. They're not far enough away to make it worth you holding the bag if you got it wrong. Here's the US 30. And you'll notice here the triangle, again, we're getting trapped in that zone. Now, this is where things got a little bit sneaky. So in the previous video, I talked about the idea that if we breach this, we would most likely look for pullbacks towards the long. And, I stick with that statement, but something different happened. We ended up going up so heavily that we had a gap from the previous market close like here, and we opened up here with the reversal of a 61.8. Now, this to me was a pretty clear short, at least down to the gap close. And that's actually where I wanted to see some reaction to the market. You can see the market tried to react there, but it didn't give the right signal. And it's all about having the right signals. Here, though, was a very clean short, I feel, going into the open. Massive FOMO. Everyone was hyped about bull, and then it's shorted off. So I think from here to here was a very interesting session. To make the new low, though, is most interesting because this means that now we have broken out to the low, and guess where we're coming back to? The trend line that's held up everything so far in this bull rally. I doubt we can make really, really big indents into shorting ahead of the CPI. I wouldn't be surprised at all to see the market kind of continue to coil in this range. So like this, but this is, right down into those kind of buying levels coming up in the next 24 hours. So very, very critical, this daily close level around the 12,173 and this trend line. So I expect if we do get further selling in the morning, there could be a potential here for buyers if they see the right signs at around those zones. Let's check the rest of the markets though. I want to mention this one, the triple Q versus the SPY. So this shows us something that's happened for a long time. We've done combos of this a lot of the times on the channel. So traditionally for a long period of time, the NASDAQ has outperformed the S&P 500. And when it's underperformed, generally we've been in a bad kind of market, a sick market, because it means growth's not doing very well. Now, recently we had a huge rally, and this is not the only rally that we've seen. We've had other huge rallies. And this is where I want to get into something that we're going to talk about again and again and again, which is, of course, what are retail traders doing? Well, we know that during this period of time, August, what happened? Well, we got huge rallies into here and we hit this zone. Then we sold off. And we saw NASDAQ underperform the SPY by a lot. Where are we right now? Well, we're seeing NASDAQ and the SPY on the same trend line. Now, what happened in August that's going to be happening here again? Well, if we have a look over on our Twitter and we scroll through, this is the chart I wanted to bring up. And it's the exchange traded call option buys at open minus the sells at open for customers with less than 10 contracts for options on individual equities. So a few weeks ago, no one wanted individual equities. Look at where they were. Terrible. And when they were generally bearish. Look at where we are in February of 23. We've pushed back to the same period that we were in August of 22. So this probably brings up one of the big storylines right now. We have the calls back in the system from retail. Well, that's exactly what you want to see if you're going to be a contrarian to this trend and you believe that somewhere in this next little period that markets could potentially not offer the risk reward that's worth it to you. And it also probably is a warning sign that if you're going bullish and you don't have, let's say, a longer term multi-year kind of approach, that you should be careful and looking for reasons to potentially be risky or risk averse, because August 22, February 23, they're the same. And we know that when we go over to these markets and we look at these areas, it's at a super critical area that maybe less people are talking about. Now, that doesn't mean, we're going down here and everything's going to crash. But at the moment, it gapped up. It's held that zone for a few days in terms of a ratio. And there's real potential chances that the market may be looking to dive down. And then if we are in a new, let's say, called soft landing market, which I'm not super convinced of, but anyway, if we are, then we come down and then we see potentially, buyers buying back in. And that's what happens during markets. Remember, the mutual funds are sitting on the sidelines going, whoa, we might have missed this. Well, it's not in their best interest to allow the market to run without them. That's very bad. So they're going to want, if they are coming in, they'll want to go in very, very soon. Let's have a look at the S&P 500. So it actually broke this little trend line here in comparison to the NASDAQ, but it's coming back into the expected weekly options low, which sits around that 404. So we kind of hit the expected weekly options high. We shorted off that zone. And then now we're going towards the low. So, with the daily closes and previous things that are around here, it may be worthwhile considering the next 24 hours as how is it positioning in. I do think, though, the CPI coming up very, very soon is going to be the critical one, and that's going to most likely have an implied vol move that's in the vicinity of potentially 3 to 5% in one day. So you've got to be very aware that there is risk coming up that's going to be extreme in these markets. S&P 500, if we're taking a look at that, we'll just get rid of this for a second. It was a very similar story to the NASDAQ. We saw the markets again pull back up. We thought that if it comes back down here, there may be a reaction. There wasn't enough reaction. It fell through and it made a new low. So when we're taking a look at this, again, we're hitting into that kind of critical box zone between that 40, 40 and 40, 60 zone. And somewhere in here is where you'd like to see the buyers come through in the next 24 hours. I'd still like to see this market coiling, and I know that seems weird, ahead of the CPI. So at least we can make a decision. If we start just shorting off into the CPI, it creates that real possibility that we're actually going to see a huge boost from it. So I would like to see it coil, kind of come down, potentially trade within the range, figure out somewhere around here, and then we see that CPI coming through. And at least that's the general consensus at the moment. We cannot discount the fact that there are plenty of buyers still willing to commit here ahead of the CPI, and there is money to suck in. So here's the demand, and it's definitely a key level to be watching over the next 24 hours. Let's have a look at the options moving forward into the 10th, and this is where the options sit: 410, 400, 415, with some sitting at 405. The max pain's at 407, so it's moved down a little bit. But in general, anywhere between 400 and 410. Wall Street, very happy with themselves, going into the weekend, eating all of the finest dinners, thanks to us retail traders losing all our money against them. Prelim UOM sentiments coming out Friday, 10 a.m. New York time, certainly was something to check out. But remember, if you don't want to be involved in risk and you don't want to get stuck, Tuesday, February the 14th, 8:30 a.m., CPI, core CPI. These are the expectations, 0.5% and 0.4%. If they come in hotter, watch out down below. Data-driven Fed, not going to be good. If they come in softer, of course, it could begin rallies as well. But even interpretation of it, it depends where the inflation is. Is it in food? Is it in shelter? Is it in sticky inflation components? That's going to be very, very important over this period. So be safe out there, guys, and make sure you're aware of that. In regards to Bitcoin, there's not much really going on with Bitcoin over the last couple of weeks, but we did see some action in the last 24 hours. We broke through our zone. So now we're kind of expecting a rally that could push us into around that 23,000 zone and then potentially now short. So we're probably on the negative side of Bitcoin after that closure, because more importantly, the market closed below. So now that it's done that, we're looking towards the market now moving back down into 20,800. So it looks like Bitcoin's made a bit of a decision. And again, notice the volume just through this exchange. It increased into it and it stayed high. So if this was some big whale trying to sell to retail, they've done a decent job considering they've got that volume disguised in there. We will find out into the inflation numbers. As always, if you've enjoyed any of this content, remember to subscribe, follow us over, link in the description down below, and check out our weekend video because it's sure to be a good one. There's so many intricate workings in this market, and it seems like a ton's going on, but really it's just in a few stocks. If you look at the S&P 500, it's been hovering within a 2% range actually for quite some time now. So we need to step back, take a look at these markets, hopefully without rose-colored glasses each way. And yes, of course, I'm leaning bearish at the moment just because a lot of the stats say it, but there's also some big bull cases to be made. And if you're interested, put comments down below because I can go through all the bull cases. It's mostly breadth, thrust, and all of those normal kind of things that you see, recoveries across the board. But either way, we're going to find out, hopefully, a lot next week on Tuesday. Bye for now.